Hi, and welcome everyone to from our downtown Ventura studio. We're very warmly welcome you all to our what I would call a kind of an emergency update. We know that Iran and the whole oil crisis has been in the news repeatedly and understandably over the last week and a half. It's causing a lot of fear, some anger, and quite frankly, concern over what this and how this might affect the United States financial markets and obviously your portfolios. And that's the reason why we're reaching out to you. We feel it is our responsibility or our duty when times of crisis occur to reach out to our clients, and that's what we're doing today. And I share your concern. I share some of your anger, and even you're wondering what does the future hold for the financial markets in lieu of a potential longer than expected oil situation where prices are much higher. So we're going to talk about those things today. In fact, let's take a look at the today's agenda. We're going to consider markets in crisis, obviously. We're going to talk about the Strait of Hormuz. We're going to look at some facts about oil that I think are very important that kind of have come to light because of this crisis that are much more longer term and fundamental in nature. And I'm going to share some of those thoughts with you. We're going to look at prior geopolitical events, specifically wars, and how that affects the financial markets. And then we're going to look at our investment philosophy and take some Q&A. In fact, feel free to chat in your question, raise your hand. You don't have to wait till the end. Gavin here, my trusted assistant, will just let me know that there's a question in the queue, and we'll get that asked and answered for you as we go through this. All right. So let's take a look at market returns during this crisis. It's very telling, and we'll go through them. So first of all, we're going to look at February 28th through March 10th, and then also year to date. So the S&P 500, surprisingly enough, down just 1.28% during this week and a half period. And for the year now, down 0.7 for the year. This is through today, by the way. The equal weight S&P 500, something that we've been talking about for months because we feel like we're in a better economy. We've got a Fed that's cutting rates. That really should benefit the other 493 stocks. You can see that's been hit the worst. And yet, look at year to date, still up almost 3%. Very, very interesting. You would expect this to be hit pretty hard because remember, the other 493 are the average companies out there. They're not the Mag 7. The Mag 7 really are not affected by the price of oil, quite honestly, when all is said and done. But the other 493 companies are, and that's why you saw a much greater sell-off when compared to the S&P 500 over these last several days. And then you've got the world index down a whopping 6%, completely understandable there for obvious reasons. But noteworthy is the fact that the world was up 9% going into this crisis, still up 4.9% so far for 2026. And then one of the things that we're most excited about, and that's the Russell 2000, the smaller companies. I would throw in mid-sized companies as well. But we're just going to look at the Russell 2000 index, down 3% during this event, and still up 3% for the year. I would argue if this was really, really, really worrying the market, I would have to say that the small cap index would have been hit far more severely than a 3% decline. I mean, that's actually outpacing the near 4% decline that very large companies in the equal weight index had to endure. So I would argue that this is actually a positive sign that the institutions, the market in general, doesn't think this is going to go on forever. We take a look at the bond index. It's been concerning, down 1%, we'll just call it 0.96, 1%, no real difference there. Down 1% during these during the war, and now up just 0.84% for the year. So I guess green is better than red for the year, but nonetheless, it is concerning that the bond index didn't do what the bond index has been doing for some time, meaning when stocks are down, bonds are up. So in this 8 or 9 days of the war, stocks are down and bonds are down. Why? Well, stocks are down for obvious reasons: fear over a recession, fear over inflation. Bonds are down for fear of inflation. The effect that oil potentially can have on the CPI. And we're gonna dig under the hood in that regard in a little bit. But that's the reason why bonds are down. And that's something that we're looking at and taking very seriously on a day-by-day basis. All right, so we thought we'd share some market information for you. Now we've got the Strait of Hormuz. I mean, this is it. I thought a geographical map would be beneficial. And you can see why there's so much concern. You've got, let's turn back here. You've got Iran up there, obviously, and then to the left, Iraq. Right below Iraq, you've got Saudi Arabia, the Persian Gulf. And of course, all the oil is coming from those countries, and it gets loaded onto tankers, and those tankers run through the Strait of Hormuz, which right now is under attack by Iran. And that's what's causing all of this. As you saw over the weekend, oil hit $120 a barrel. The last time that happened, surprisingly, was not so surprisingly actually, was back in 2022 when Russia invaded Ukraine and started that war. Oil temporarily hit $120 a barrel. Now, I'm going to sit here as the optimistic guy that you normally see, and I'm optimistic, don't get me wrong, but I'm fact-based. This is far more of a concern than what happened 4 years ago when oil hit 120. There was no Strait of Hormuz. We were not worried about tankers being attacked, basically having not only oil shipments down, but a lot of other shipments. Fertilizer, for example, comes from this area too. And that's all shut down. So this is an economic shutdown in a very, very big way of, depending upon who you believe, 20 to 30% of the world's need for oil, all right, passes through the Strait of Hormuz. So really all of this is about unclogging this artery. We need to get a stent here and put it in. And how that's going to happen is anybody's guess. And we're not here to talk politics or military strategy. We're here to educate and help people understand who might not ordinarily have seen a map like this, understand exactly what's going on here. All right, so a question that comes to mind is, where's this oil going? Who's dependent upon this oil? I thought this map here is very telling. Look down there at the lower left-hand side where it says the U.S. We're only relying on 2% of this particular oil. Look at the countries that are really relying on it. China, South Korea, Japan, and India. My goodness, India gets 50% of their oil from this passageway. China gets 50% from that area. And you can see Japan, an astounding 72% of their oil thirst comes from there. So a couple of things are striking. Maybe they are to you, and we'd love to hear your thoughts if you have some that I don't mention. First of all, not affecting the U.S. at all. This is a worldwide problem, and it is really a problem confined to India, Japan, South Korea, and China. Even Europe, it's only 18%. So something that stands out there to me is, look, there is a lot of political will to get this thing over with. We know that China and Iran have commonly been referenced as friends. I wonder how that friendship is going right now. Certainly China has a huge amount of motivation to get this over with. They need oil probably as much or more than anybody does. Half of their oil is coming from this area. Same thing with South Korea, a very large economy. Japan, obviously, a big one, and India as well. So political will could very well change things up and reduce the time that that passageway is blocked and that oil prices remain elevated as they are. Now, fortunately, we've seen oil go from 75 at the beginning of this crisis all the way up to 120, as I mentioned before, over the weekend. Got as low as, I think, 81 or 82 on some, unfortunately, false reports about the military escorting tankers through. Well, now we're back up to 87 or 88, and who knows what tomorrow is going to bring. All right, Gavin, we have a question?
We got it from Ken Magdalano.
Hey, Ken.
He said, I thought the U.S. percentage would be more, but it appears that oil is not the real reason for our place in the war.
Yes, exactly. So again, I mentioned we wouldn't talk about motivations and politics, but you're absolutely right. There's no question about that. And this is why it's interesting, particularly with regard to China. They've not really been bombastic in their condemnation of what the United States has done. And again, that's not politics, that's just a fact. And interestingly, it was last week, during the week, that China decided to buy a whole bunch of airplanes from Boeing, of all things. And we know in April, President Trump is going to China to meet with Xi to have trade talks. So it feels like there isn't the animosity that maybe we've been led to believe between these two nations. And potentially the friendship that we've all heard about between China and Iran may well be diminishing. The bottom line here is money and power, and you can see that a lot of their energy is coming from this area, and that cannot go on for much longer. Thank you for that question, Ken, by the way. All right, so let's take a look, though, at how serious this is, because it is serious. I remember when I was a teenager, being in the gas lines with my dad, the odd and even days. Some of us in the audience remember those well. That was this crisis here, the Arab oil embargo in 1973. And notice there that there was a 7% disruption in supply. Some of the other crises, the Iran Revolution, there was a 5% disruption. 1956 and 1957, I didn't even know about this one until I did this. There was a Suez crisis where 10% of the world's oil supply was disrupted. We'll take a look at what's happening down here. That is an astounding number, 20%, and there's no spare capacity. In these other cases, these other instances, there was capacity. And so this is probably the reason why you probably may well have heard today that the European Union, I believe it was, released 400 million barrels of oil. Now, my guess is, and I forgot to research this, but I believe I've heard that it's 20 million or so barrels a day flow through the Strait of Hormuz. If that's correct, then they released 400 million barrels. So simple math, that's 20 days, 3 weeks of oil supply. So maybe they're setting a time limit on this. Maybe they're not. I don't know. But this is a very serious crisis because there is 0% spare capacity in the world right now. And so you can understand why we've had these wild swings up in the market. Now, here's something from the UAE, their Institute for the Study of War. So this isn't from some other political outlet. This is the UAE. And what this is the Iranian ballistic missiles, cruise missiles, and drones launched at the UAE since the beginning of the war. And you can see in the beginning of the war, wow, there was a ton of them. I mean, particularly ballistic missiles and drones. We all heard about the drones. I mean, my goodness, on March 1st, there were 332 drones sent that way. But what's noteworthy is these numbers have diminished significantly, particularly in the last few days, where you have basically 9 and 15 ballistic missiles that were launched and just 18 and 35 drones. Really very difficult to make a case that that is a serious offense. Time will tell. Are they just prepping up for a larger attack, or have they been damaged so severely that they don't have the ability to attack? We don't know the answer to that. But this could be, and I underline could be, maybe a signpost ahead that this is a lion that is lost a lot of its teeth, and that things might be closer to an end than to a beginning. We all hope and pray that the end does come soon. Paramount are the lives of every human being involved in this terrible war. Speaking of which, we know you're concerned about your assets and your money, and well, you should be. You didn't push any buttons. You didn't call for this war. And so we understand your trepidation. I know this is a busy slide, and it breaks most of the rules of PowerPoint presentations. Keep it simple, and we usually do. But I thought this was important because what this does is it shows over the last nearly 100 years, from 2023 all the way back to 1928, shows the S&P 500 throughout that nearly 100-year period, and then all of the other wars and conflicts that have occurred along the way. And I'll tell you, obviously, the market is volatile, and there are many periods where the market declined a lot. I mean, this was 1929. This is the Great Depression, right? This really didn't have anything to do with a war. If you fast forward it to this area here, 1998, 2000 to 2003, where you had this decline, that was the dot-com bubble bust. Then there was 9/11. And then there was the Enron fiasco. So really nothing to do with a war. And then the great financial crisis in 2008 was this big drop right here. So when you take those more organic and fundamental drops out of the equation, you really see very minor drops and then follow on big rebounds in stocks in all of these crises. Now, again, as I said in my preamble, I don't think this is that minor. I think this is probably more important than a lot of people are giving it credit for, particularly when it comes to the potential for causing inflation, which we're going to get into here. But it will end. These have always ended before. They've begun and they've ended. The market has fallen a bit, as we illustrated in the outset. We've seen a decline in the RSP and some of the other indexes that are more volatile. But it's not been tragic yet, and we hope it never becomes that. And if history is any guide, then history will rhyme and will essentially repeat itself. And as a result, all will be okay. And we think this won't be any different going forward. All right, so let's talk about some longer-term thoughts on oil. You've got an underinvestment in oil exploration and production. Now, try and set your politics aside. This is very important because we're trying to explain one of the reasons for the spike in oil. Remember, we talked about that one screen that showed these other crises. There was excess capacity. In this particular crisis, there is no excess capacity. And a lot of that is as a result of what has gone on in the United States over the last 10, 15 years, where there was a huge push toward clean energy and almost a paranoia or demonization of drilling for oil. And so therefore, as a result, you've got an underinvestment in this area, and it takes a while for that to reignite. I'm not an oil man, and neither are you, but I don't think you have to be an oil man to understand that, wells dry up. They just do. And you've got to find new places to drill, and that's what's going on, that natural decline. And not to be taken lightly is OPEC Plus's decision to be very disciplined when it comes to turning on and turning off the spigot. They want the price of oil to be X. And if it goes too much lower, they just stop producing, or they reduce their production significantly, and of course vice versa. People have to understand that area of the world is doing everything they can to diversify their economies. One of the things that they're doing is spending an enormous amount of money on infrastructure in these so-called smart cities. Trillions of dollars will be poured into these. Where's that money coming from? Well, we know it's coming from their oil profits. So they are going to keep oil at a certain price as a result of not allowing too much to be pumped. Okay? And it's really no more complex than that. Moving forward here, U.S. shale growth is slowing. I'll speed through these. We know several years ago during the war in Ukraine, there was a releasing of a significant amount of oil from our strategic petroleum reserve, and neither the last administration nor this administration has seemed to put those barrels of oil back. And so that's a problem. And then, of course, global demand is still growing. The global economy is still expanding. And as it expands, it needs oil. So it is a potentially very serious problem. So let's talk about one of the big concerns that we hear every day on the news about oil and inflation. So first of all, some good news. Oil accounts for about 4% of the CPI. Now, that's not a big number. And you're hearing it bandied about, oil's gone up, inflation's going to go through the roof. Well, look, we all agree if oil stays above 90 or 100 for a long period of time, emphasis on a long period of time, that is going to cause a recession. It's just that simple. We cannot sustain our economy, nor other economies can be sustained with oil at that level for a long time. History says it can't. Any other time we've had that kind of price in oil for many, many, many months, a recession follows. And then the price of oil goes down because the demand goes down. People just stop driving as much, and so they don't buy as much oil. So yes, it only impacts 4% directly, but take a look at some of these other numbers here. Higher oil causes other components of the CPI to rise as well. And experts say that for every $10 increase in a barrel of oil, it adds anywhere from 0.2 to 0.4% to the CPI. So over the weekend, when oil hit 120, it was basically $50, close to $50 more than what it was for most of the last many, many, many months. On the high end, that's a 2% addition. Inflation right now is at 2.4. You add that together, that's 4.4. The Fed cannot lower rates. In fact, the Fed would have to raise rates. So very, very disastrous. Very, very important for all parties to get that strait opened and for oil to flow through that strait. Take a look at this chart here too. As we mentioned, 4% is directly affected by oil itself. But then when you look at other things like food, that's a 13% weighting in the CPI. Higher costs for tractor fuel, fertilizer, and delivery. So these are the unseen, not intangible, but just the not well often thought of effects that higher oil has on the overall rate of inflation. Transportation services, 6% of CPI, and other goods, 20%. Higher manufacturing costs for plastics and chemicals. So this is a serious thing, and we're not taking it lightly. We do remain optimistic that it will get resolved, and that's why this screen shows up. Some are wondering, wow, maybe we should get out and then get back in when it's safe. Well, as I've asked that question before, if somebody can tell me when it's safe, call me, okay? I'm all ears. But I love Peter Lynch's comment where he says far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. That's a true fact. A great chart that we shared at our last town hall. If you're invested $1,000 25 years ago in the S&P 500, that 1,000 turned into nearly 6,000, is represented by the green bar. But if you go down to the third bar, the third blue bar, if you missed just the best 10 days, that return went from 5,900 down to 2,600. Okay, not a very good result. So we can't time the market. We're not going to try to time the market, but we're going to continue to do what we do. So it's not all gloom and doom. This economy is still expanding. The Fed is still expected to cut 3 or 4 times this year. We're going to have a new Fed chairman in May. It's unlikely that Mr. Powell will cut next week, I think, when the Fed meets next, given the fear about oil inflation, and that's a righteous fear. They probably shouldn't cut next week. But I would imagine by the next meeting, this situation will be greatly resolved and more understood, and the Fed will begin to cut again. That will be very good for your bond portfolio. It'll be very good for stocks, and it will be stimulative to an already reasonably strong economy. One of the reasons we can say that, and this is not so much by listening to the economists that we respect, although we do, and we do respect them and we take their advice. But you know what? If you run an AI Google search on this quarterly earnings reports and the conference calls and transcripts that are available to the public, you would find that the more and more of the CEOs and CFOs are talking about economic expansion. So instead of talking about inflation as they were a year ago, and 2 years and a year before that, if you Googled the same word recession, that was on the minds of CEOs. Now what they're talking about, and of course it's not getting any press, they're talking more, they're using the term economic expansion more and more and more. That's a good sign, because those men and women, those CEOs and CFOs, they're on the front line. They're seeing what's actually going on in the economy real time. And this is what I'm very happy to report to you. And of course, we've been talking about the tax refund effect that's going to have a very, very powerful for consumer spending, upwards of nearly $300 billion in additional, over and above additional refunds over last year to corporations and to individual taxpayers. That's going to be very stimulative for consumer spending, for example. And we should just begin to be seeing that as refund checks will start coming in this month, and mainly April, May, and June. We'll see a very strong effect there. All right. So our investment strategy for times like these has not changed. We continue to love the broad market. We talked about the RSP being down a lot during this downturn, inflation, recession fears, but still up for the year. We continue to like this. We're buying on the dip. We're doing that for many of you. Small and mid-sized companies, surprisingly strong during the downturn, very much so. That's a very good omen, a very good indicator of what lays ahead for that index. And bonds, despite inflation concerns, should still have a solid year. And it is disappointing over the last 7, 8, 9 days during this crisis that your bonds have fallen in value. It's not been significant, but the percent that they've fallen is frustrating. but it's directly a fear about the 10-year yield rising because of inflation concerns. Again, this thing is over in 2 or 3 weeks, and we all pray and hope that that is the case, not just for our pocketbooks, but mainly for humanity. Then all of these bonds will retreat or move right back up to where they were, and well beyond. So, we love these areas here, and of course we're going to buy on the dip. We think this is an opportunity, not a reason to be overly afraid. All right. So with that in mind, on behalf of my entire team here at IWA, the hardworking men and women that care deeply about each and every one of you, I want to say thank you for being a client and friend of ours. Thank you for taking the time out of your busy schedules to tune in today. We will be sending out a copy of this to everyone once we get it edited. And you can look at it again, and please feel free to reach out with any questions for me. And Gavin, are there any other questions?
No question.
Fantastic. So again, on behalf of all of us here, we thank you, and we look forward to seeing you next time. Talk soon.